Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kirill Prakapenka and Greg Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
Huge debt, aging population. Is China past its peak? So ran a recent headline in The Australian, and usually when such headlines hit the front pages, the news is priced in. This episode, Greg and I assess the worries surrounding China's ailing economy. Do Aussie investors have anything to fret about? You'll have to watch the full episode, but Greg did warn the iron ore miners could see a downgrade cycle from here, so be warned. We then discussed the overall market, pointing out that when valuations are stretched, it doesn't take much for things to snap. We ended with advice from Warren Buffett himself. The stock market is a device for transferring money from the impatient to the patient. Hello and welcome to the 13th episode of What's Not Priced In. Lucky 13th. We're recording this episode on Wednesday afternoon, and it does seem apt that the 13th episode is coinciding with the market beatdown. The Aussie market is getting absolutely smashed right now, but it does serve as a nice background to today's discussion, which is all about the state of the market in general, with a focus on China and the consequences of its slumping economy in particular. Now, for a few episodes, we've been saying the stock valuations are overstretched, and it's certainly not there's less attractive reward given the risks entailed. And when valuations are stretched, it doesn't take much for the market to fall. And clearly, with all the bad news coming out of China, it was enough to nudge Aussie stocks lower. So, Greg, welcome. How are you feeling right now? How's the portfolio going?
Thanks, mate. Yeah, it's not too bad. As a value investor, you actually quite like these sort of days where and let's not overstate it. It's not a huge drawdown considering we've had pretty strong past couple of months. But as we've spoken about, the risk and reward equation hasn't been favourable for a little while now. Reporting season kicked off last week, and while those reports were the ones that have been out so far broadly okay, there's just not a lot of additional follow-through buying that you're seeing, apart from the odd stock that has rallied, and then there's others that are sold off quite sharply as well. So we're not in a situation where I think there's a particularly good reason to celebrate the results. We are sort of moving from a first half of the year that was broadly strong in terms of nominal economic growth, and moving into a slower second half of the year. And it doesn't surprise me that the market's really struggling to get some traction on the back of the results that are largely in line with expectations. And while there has been some good, better than expected results, there's also been some disappointment. So broadly, it hasn't really done anything too well. And now we're seeing the bad news out of China, which we'll get into, and that has just given investors a reason to press the sell button, and especially in light of the fact that sentiment indicators were quite stretched, as we pointed out last week. And when you get to the point where sentiment is really stretched and the valuations are really stretched, it doesn't take much in the way of bad news for the selling to kick back in, and that's what we're seeing now.
I think now we can maybe move on and discuss everything that's happening with China and any spillover effects on Australian key commodities like iron ore. Obviously, China is an important trading partner, and we've got plenty of big resource stocks that sort of weigh heavily on the ASX 200. Yep. So what do you make of everything that's happening in China? What's your assessment?
Yeah, look, we've spoken about this in recent weeks. The data coming out of China hasn't been strong. The best thing I can say is that China will probably muddle through. I wouldn't, and I've said this before, not expecting any major stimulus unless things get really, really bad. The overarching, objective of the Chinese Communist Party is social stability. They're not looking to juice markets. They're just looking to make sure that unemployment doesn't rise to such levels that it creates instability. So I guess there are a couple of concerns in that they've stopped reporting youth unemployment, which means that those numbers must be pretty poor. I think the last time we spoke about this a couple of weeks ago, we said youth unemployment rate was around 20%. So the fact that it's probably higher than that is a source of concern, because when you've got idle youth on the streets, that's sometimes not a good combination for social stability. And the fact that there's a lot of money tied up in the shadow banking system of China, and that is where you're starting to see some problems. A couple of the bigger trusts and a couple of the bigger property development companies have missed payments. And when you think about a modern financial system, the flow of money and payments is effectively like a pass the parcel. Someone gets a payment that they hand on to someone else, a portion of it, and it relies on the flow of those payments to keep the system running smoothly. And when payments are missed, that creates flow-on effects, because obviously, the other parties to that payment can't make their payments to other counterparties, and everything starts to sort of freeze up. And that's the biggest risk. In saying that, we've been here before with China. There's been similar episodes over the past few years of these flare-ups, and they have been contained. So my sort of shorter term view is that you're probably seeing a situation where most of this is now out in the open. It's in the news, and it's being priced in. Longer term, I think China continues to have some issues. And if you look at their demographics, 2022 was the first time that population didn't increase in China. And 2023, overall population, I think it was fell 0.7%. So we're now at an inflection point with the demographics in terms of population growth. So that is a major structural challenge for China. And then I guess the other thing to keep in mind is that post-COVID or throughout COVID, Western developed economies printed a whole bunch of money and then spent a whole bunch of money through the fiscal channels. So you had monetary and fiscal policy working together, and that created inflation, and that created a boom in many different areas, stock market, economic boom, all that sort of stuff. China hasn't done that. China hasn't really put in a huge amount of monetary or fiscal stimulus. So the opening up phase, yes, there was a rebound based on the economy returning to somewhat normal activity, but it wasn't in any way juiced up via fiscal or monetary policy in the way that the Western economies are. So it's interesting to note that because of that, China is now grappling with deflation. And I guess that begs the question, is that what is in the future for the Western economies if their fiscal stimulus starts to come back down into somewhat more normal levels? And if you look at the US fiscal situation, I think we mentioned this last week, they are running probably on target for about a 1.6 trillion plus deficit this year, and that's to the year to September 2023. Going into the next fiscal year to September 24, the fiscal deficit is going to be is projected to be larger than that as well. So yeah, there's a question marks about longer term, what the effect of that is going to be, how much of that spending is actually productive, how much of it actually produces economic growth, and that's the big question. But certainly from a right here, right now, I think a lot of the China news is probably in the price. And a headline I just saw pop up on the Australian where I was we were preparing for this. It came up on the homepage of the Australian. It says, huge debt, sinking housing, aging population. Is China past its peak? So in the theme of this show, I would say it's in the headline, it's in the price. So if we want to move on and have a quick squiz at some of the charts that have really been exposed to this, we can maybe have a look and say, maybe the worst is over for the time being. Okay, so we got a chart of Rio Tinto. All right, so the important thing just to point out from here, from a very short-term perspective, and this we are recording this on Wednesday afternoon, so these charts update with end-of-day data. So this doesn't include today's move, which is another couple of, well, maybe 1.5% lower. I think it's down early when I looked to 104 something. But as you can see here, this is a momentum indicator. This is the relative strength index, very much in the oversold region. So I wouldn't be surprised, and especially considering it's at a longer term. If you look at that, it is quite long term. This support resistance line, has been a reasonably decent marker of where support and resistance comes in. So I wouldn't be surprised to see this bounce short term. But as you can see, these are a medium term moving average indicators. This is 50 and 100 day moving average. And that's just started to, it's crossed over now, which indicates that we might be moving into a shorter term, a medium term downtrend. If we look at BHP, and I should point out with Rio, it is pretty much an iron ore miner. It's 83% of its underlying EBITDA for the first half of this year, which is the 6 months to June 30. 83% of that underlying EBITDA or underlying operational earnings relates to the iron ore business. The iron ore business has got a 63% return on capital employed compared to a 4% return on aluminium and 4% for copper. So really, Rio is a iron ore company with a couple of other smaller divisions contributing. But when profitability falls for iron ore, it has a massive impact on Rio's profitability and share price. So if you look at BHP, not quite as impacted purely because it's not as exposed to iron ore. BHP, 58% of operational earnings relates to iron ore. It's also got metallurgical coal, thermal coal, copper, nickel. So it is a little bit more diversified. Didn't state its return on capital for iron ore, but it does have a 65% EBITDA margin. So very clearly these operations are very, very profitable for both BHP and Rio. And for Fortescue, I'm actually a bit surprised that this share price has held up reasonably well. Fortescue has got a lower quality iron ore product, so its profitability is far more sensitive to movements in the iron ore price. But as you can see, we're approaching oversold levels here as well. All right, well, let's have a look at the chart on the screen here. We've shown this a few times over the past few months. It's the iron ore chart overlaid with the yuan US dollar exchange rate. And as you can see down here, that with the recent bad news about China, that exchange rate has fallen to lows that are really back down to these October lows from last year, when obviously equity markets were lower as well. But the iron ore price is still up above $100 a ton. So if you think about that, that to me, that is the risk with the iron ore miners, that iron ore price will continue to fall and match with the yuan US dollar exchange rate. And if it was to do that, you'd be back at around about $80 a ton, which I think is a more of a fair indication of the long-term iron ore price under an economy where China's not necessarily in major trouble, but it is muddling along. It's not growing particularly strongly, but it's not in sort of outright recession or very, very low growth. And I think China's growth will trend lower over time, but I don't think it's necessarily going to be anything too drastic. And if we then take a look at some of the iron ore majors earnings projections, and a couple of weeks ago when we did the valuation segment, and I discussed this market screener tool that I use, and it has all the financial data from companies. So one thing just to point out here is that the net income, which is effectively your net profit, so for 2023, it's forecast to be about $10.5 billion. And for 2023, they've got an end year of December. So that's December this year. And then next year, the profits forecast to increase a little bit. And then we're back to sort of falling a little bit in 2025. So I think those numbers are very optimistic. And I would expect over the next, 6 to 12 months that you're going to see a downgrade cycle kick in for the iron ore miners. And Rio is just a good example of those profit projections or profit forecasts being a bit too high. And that leads into saying, okay, if you're just looking at basic things like PE ratio and yield, then these are potentially value traps, because you look at Rio and you say, okay, I'm buying it on, FY23 or 24, I'm buying it at 9 times earnings. Oh, we've clearly just had an update. That's live update and changing numbers in front of us. But we're looking at about nine times earnings.
They're listening to you, Greg.
Exactly. 9 times earnings, over 6, nearly 7% divvy yield, and you think, okay, that looks great. This is a world-class miner, but it doesn't take into account that I think you're going to see earnings downgrades. And if you look at Fortescue, which is, as I said, it's a pure iron ore miner, and then if you go and have a look at its net income forecasts, 5.6 bill for the year that's just gone, so that's more or less in the bank. Projections are that it'll fall considerably next year, down to 4.3 bill, and then again in FY25 down to 3.3 bill. So that is roughly a 40% decline over the next 2 years in net profit expectations, yet Rio is expected to be largely flat. Now, I'm not saying Rio should be down 40% over 2 years, because Fortescue has lower quality product. It's much more sensitive to iron ore prices. But when you look at FY25 numbers, then you've got 12.7 times earnings, and I wouldn't be surprised if these get downgraded as well. The other thing with Fortescue is they're pumping a fair bit of money into renewable or new forms of energy, which may or may not bear fruit, and I guess will almost certainly not. If you look down here, and it's one of my key things to look at, Fortescue's generating a pretty decent profit on its iron ore operations. There is almost zero chance that its reinvestment of its iron ore profits into hydrogen and green energy is going to get anything like that type of earning. So I would say Fortescue should be on a discount compared to the other companies that are not pursuing that path. But just in terms of the majors, you look at them and you think, okay, they're well priced. Should we be buying them? They look like value traps to me. Notwithstanding, I think you're going to get a short-term bounce purely because the China story is in the news. Everyone's talking about it, and obviously that's leading to everyone wanting to sell anything exposed to China, so that opens it up for a short-term rally. But I think longer term, you're going to see downgrades for the iron ore pricing cycle. So I'd be steering clear for a while.
Well, speaking of optimistic projections, I actually did a quick valuation of BHP in this week's Monday Morning editorial, and I used your return on equity valuation formula, and I also used the market screener for the consensus forecasts, and the initial valuation was quite absurd, almost doubled the current stock price, and that's purely because the forward FY24 return on equity projections were so high relative to BHP's historic average. So when I used BHP's 10-year average return on equity and excluded the last 2 financial years, I got a valuation of about $40 a share, which is pretty much where the stock is trading right now. So basically what I'm trying to say is that with those forward estimates, you really have to be careful and sort of apply your common sense. Analyst estimates are almost always biased to the upside.
Well, that's a good point. Analysts are nearly always more optimistic in the upgrade cycle, but in the downgrade cycle, they sometimes go a little bit too far. And one of the things I mentioned before that I always like to do is look at stocks that have gone through a downgrade cycle. So you might be buying in when the earnings per share projections have fallen 30, 40, 50% from what they were maybe 9 to 12 months ago. And when you do that, you're buying in at a relatively low earnings expectations compared to what it was back at the highs. And talking about that valuation model, it's a really tricky thing to use with resource companies, because resource companies are capital intensive. So therefore, their dividend payout ratios can be lower than normal, which can overstate the valuation because they're not necessarily generating high returns on reinvested capital. In the case of Rio and BHP in their iron ore operations in the Pilbara, they're some of the most valuable assets in the world, and they are generating, and have done for some time, generating very good returns. But at the end of the day, it depends on what your expectation is for iron ore prices. And I don't think longer term, the market is looking at an $80 iron ore price. And that's the thing with the way that valuations work. The market will, even though the next 12 months earnings are just 1 year of earnings amongst let's say 20 years of earnings that that will feed into a valuation. But the market puts a huge amount of importance on that next 12 months because the way that certainty or uncertainty is priced in share prices, that when there's certainty, it gets priced in because the investors want certainty. They will pay for certainty and they will not pay for uncertainty. And you're seeing that in a lot of cases where an annual result might come in better than expected or along the lines of expectations. It gives investors confidence, and that share price will maybe be bid up to a price where you think, oh, that doesn't really make sense. It's quite expensive. But because it has delivered certainty in this earnings period and hasn't given investors reason to be concerned or nervous about the future, then that next year or that very short term earnings certainty is priced in. And from a contrarian perspective, that's where it's really important to think about how that works on certain stocks. Because if you are a little bit patient, if you can be prepared to and I'm not saying take a large position straight away, but if you might want to say, look, over the next 6 months, I want to buy 3 tranches of this stock. I know it's not going to do much for the next 6 months, but beyond 12 months, it doesn't look too bad. And 12 months comes into view reasonably quickly for the market. So, for example, there was a couple of gold stocks that reported their pretty ordinary fourth quarter results last month, and the share price reaction was really swift. Investors just dumped the stocks, and I'm specifically talking about Regis Resources and Silver Lake. And sure, that they weren't great results, but there's a lot of reason to say, okay, the next 12 months is going to be pretty ordinary. But beyond 12 months, then there could be a decent earnings recovery, albeit with uncertainty. So if you're willing to, and if you look at your valuation, you say, okay, well, I'm not paying much here. Like I'm buying the assets and I'm buying, the cash flows for more than 1 year, then you could well quite have a bargain. But you've got to be willing to sit through a period of time where the market tells you you're wrong, and you feel like a bit of a bit of a loser for buying into a stock that continues to go lower, or whatever it might be. But if you've done your homework and you think, okay, well this turns around in 6 to 8 months' time because of X, Y, and Z, then they're the positions to take. Because a lot of the time, when you're just buying into a stock that has delivered and you're paying overs for it, as soon as the disappointment or as soon as the uncertainty comes in, then that stock will, fall considerably. So, I guess in earnings season and what we're in now, it's just important to keep in mind that the market does have very big, or is very sensitive to the very, very short term, even though it is a longer term time frame that is really about. A longer term time frame is what justifies an overall valuation, but the market does focus very short term on it.
And that presents opportunities. I think it was Warren Buffett who said the stock market is a device for transferring money from the impatient to the patient.
Exactly.
And that's why I think investing is so hard. All the certainties are priced in, all the obvious implications are already accounted for, and it's the uncertainty where the outperformance resides, along with risk and disappointment, of course.
And you got to have a personality where you're not, you don't particularly care if you're doing something popular or not. You have to almost gravitate towards what is unpopular. And just as a good example of that, a stock that I've been looking at lately is Star Entertainment Group, and it has fallen 60 odd percent over the past however long, 12 months. If you read its latest half yearly report, it's got a rap sheet of pages and pages about all the problems that it's got. But it has, pretty underlying all that, it has pretty decent assets. So I'm not saying that I'm going to be recommending it, but I just think, these are the sort of stocks that I like to do a bit of work on, to think, okay, well, if you look through a couple of years, it's clearly going through some tough times. It's got all the regulators, hanging over it. It's got, some consumer discretionary spend issues. There's just so many issues hanging over it that clearly there is some value there if things get better in the next 12 to 18 months. And they're the type of opportunities in this market that I think I'm more preferring to look at as what's the real sort of contrarian play, as opposed to what's done well this reporting season, and should I get a piece of that, because there's no outperformance in that.
I think your approach there sounds a bit like Michael Burry, who I think preferred to focus on what he called roadkill stocks. So stocks that most investors are initially repelled by, but then the stocks sort of revive themselves into good investments.
Well, that's certainly the case with Star Entertainment. Yeah, I'm not sure if he's scraping that off the road, that one. But yeah, I mean, look, these are the things that's interesting, and if you do, it takes some time to do the work on those type of companies, because you've really got to try and assess loads of things. But it comes down to position sizing as well. If you want to put 0.5% of your portfolio less into that, then if it doesn't work out, it's not going to be a disaster. And you start off with 0.5%, and if things sort of track along the way you expect, the way that you anticipated, you can increase your exposure. So there's all different ways of managing it. You're not suggesting you sort of load up on that and hope that you're going to get a doubler in 12 months. So it's all just managing risk. That's the way you look at it.
Now, we've spoken about China and the spillover effects on iron ore stocks in particular, but I wanted to get your thoughts on any effect on the Aussie dollar. I just saw that the Aussie dollar just sank to a new low relative to the US dollar, the weakest level since, I think, November 2022. So the Aussie dollar actually fell about 4% this month alone. So what do you make of that, and what does this mean for the Australian market and Aussie investors and maybe the average Joe out there?
Yeah, it doesn't mean a great deal, to be honest. I mean, you could sort of trot out the old one about overseas holidays costing more. They're costing more anyway, regardless of what the dollar's doing. I think the dollar's probably the least of people's problems when it comes to that. But really, I look at the Aussie dollar as a barometer for global economic growth. And again, we've mentioned this before, but even though we're seeing financial markets, especially in the US and to a lesser extent Australia, stock markets are giving the impression that we're in some sort of start of a new cycle, or that the worst is over and growth's going to come back. But if you look at the Aussie dollar, that's telling you that the global growth environment is not improving, and the fact that China, which is the world's second largest economy, is slowing markedly, that's an indication that global growth is going to continue to struggle. And then you've got the lagged impact of monetary policy, which wouldn't be an episode of What's Not Priced In without talking about the lagged impact of monetary policy. And I think you've got a pretty good quote that I don't know where you dug that up from. Was it maybe the RBA's minutes? You got that on hand? Because I thought that was quite interesting.
Yes, about the mortgage payments.
Yeah, mortgage payments and people dipping into offset accounts and that sort of stuff.
Yep, I've got it here.
Right, let's hear it.
So this was from the Reserve Bank's latest board meetings, and it said, scheduled mortgage payments as a share of household disposable income increased to 9.4% in the June quarter, around its historical peak. So that's not good news at all. But I think the most interesting part was here, and it said, voluntary principal payments into borrowers' offset and redraw accounts declined in the June quarter. Net flows into these accounts had declined to be noticeably lower than the pre-pandemic average, consistent with pressures on disposable incomes. So that's quite significant.
So, I thought that was interesting because, a lot of people have been talking about the fixed interest mortgage cliff. A lot of people are coming off fixed interest loans and moving into higher variable loans. And I'm seeing more articles saying what happened to the mortgage cliff. I thought we were going to have all this terrible news out because of it. And it was certainly priced into retail companies a couple of months ago. And I think when the bad news didn't surface, the retail companies have been bid up quite strongly. So they've had really good rallies recently. But the reason why your quote is important is because it talks about the lagged impact of this stuff. People don't stop spending immediately. People start to draw down their savings. People make different consumption decisions, but they don't necessarily turn the tap off straight away. So this, to me, is about a slow moving situation where higher interest rates are slowly having an impact. And that will continue to play out this year, and it will continue to play out in 2024. And then by the time that the RBA sees that those interest rates are really having an impact, they'll turn, but it'll be too late. The effect of all that tightening will have really started to bite. Then they'll turn the ship around, but then that stimulus will take some time to flow through into the system as well. So yeah, it really just goes to show that people's decision making doesn't happen straight away. I guess most people in Australia, in order to support their mortgage now, you've got two incomes going into it. And in prior years, those two incomes were more than enough to support mortgages on low interest rates. But now you're seeing those two incomes being more and more put towards a mortgage, which means the offset accounts are declining, the savings are declining, and some of the more discretionary spend is beginning to decline as well. But again, to me, it's early days in that process. And if we look at the US situation, everyone talks about, the US is different because they don't have variable interest rates, it's all fixed. But again, the lagged impact of when your mortgage comes due, when your debt comes due, you have to refinance at higher rates. So over time, every single month in the US, you've got a bunch of people, whether they've got home loans, whether they've got consumer loans, auto loans, corporate debt. When that becomes due and they have to refinance at higher levels, that's an added burden to their costs. And the same with the US government. Their low cost debt that's coming due needs to be refinanced at higher costs, and that's why their interest payments are getting crazy high, and that will continue to hurt them as they continue to have to refinance. So again, early days to me in this process, and perhaps this initial sell-off that we're seeing, and we've been speaking about it for the past couple of weeks, that the market doesn't really be seeming to price in too much in the way of risks. Maybe we're at the start of that next drawdown that starts to price in some risks. And as I said, as we said last week, once you see sentiment start to turn, once you see sentiment start to get negative, that'll be the indication that it's probably a good time to get in and start buying again.
Yep, and I think the Reserve Bank itself said a few weeks ago that it takes time for households to actually respond to interest rate rises. Household spending patterns don't actually change overnight, and people's buying behavior, it doesn't change on a dime. So the effects of rising rates take time to sort of percolate. People begin to slowly realize that, things are getting a bit costly. Let's stop going out as much. Let's stop making as many discretionary purchases. So gradually, it's like a slowly deflating balloon.
Good analogy.
Or like a raging party where people sort of drop off one by one instead of a mass exodus.
What are you, the last to leave there, Kirill?
No, I'm always the first.
Always the first. Fair enough.
Well, with that said, any final comments? What's the market not pricing in?
Well, to me, it's reasonably early days. If we are at the start of another sell-off, I think it's reasonably early days. Obviously, the China story is dominating at the moment. Shorter term, I think a lot of that's priced in. Just seeing way too many headlines on how bad and how risky China is. So by the time you're reading this, listening to this, you're probably going to be seeing green on iron ore miners. But be cautious of those longer term revisions to iron ore price forecasts and the effect that will have on future profits. So I'm not getting excited yet. Time to get excited when everyone's bearish, and we've still got pretty high sentiment indicators. So we'll check back in on that next week, mate.
Yep, I think the CNN Fear and Greed Index, it's still at greed, so the party's still going on.
Still plenty of people there.
Exactly. All right, well, with that said, I'll catch you next week.
Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing, and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.